Good evening. Tonight, it's my great pleasure to welcome members of the American Society, Council of the Americas, special guests and friends. And I not only want to welcome the people that are here tonight, but I also want to welcome everyone that is joining us via webcast. And I want to thank Telefonica, who is our webcast sponsor. And of course, I always want to thank the Latin American Venture Capital Association and Cate Ambrose, its president and executive director, for partnering with us on this program. Tonight, I think it's our 6th annual program with LAVCA here at the Council of the Americas. And tonight, our panelists will be sharing firsthand some of the stories of the most exciting investments in the region, and there have been plenty, and examine how private equity firms create and preserve value in the companies and with whom they partner, including environmental, social, and governance. Following the conversation, which will be moderated by Michael Rogers of Ernst & Young, Michael will open the floor from questions from the audience, and I guess we might be taking questions from the webcast as well. So I just want to welcome you all here this evening to the ASCOA, and with that, I will pass it over to our moderator, or to Cate, sorry.
Thanks, Susan, and delighted, wow, 6 years. I hadn't realized how time flies. Delighted to be here. Of course, Susan is a member of the board of directors of LAVCA. We have another member of our board of directors on the panel today, Martin Diaz Plata, and a great representation of our member firms, so delighted about that. Just briefly around the program that we're hosting tonight and the topic that we have decided to focus on. I should say that we have been seeing for about the past year or so now growing interest among our member firms on issues related to the environmental, social, and governance impact of their investments in Latin America. It's interesting because actually this is a natural fit for us. It's a topic that in many ways we have been messaging on and focusing on LAVCA for years as we talk about value creation and the positive impact of private equity investments when we interact with governments, policymakers, the media in Latin America. It's a very important issue because, of course, in a region like Latin America, private equity firms are not using financial engineering, leverage, or restructuring as tools to grow companies. It's a growth equity region, and inherently we see strategies where it's about job creation, professionalization of traditional businesses and family-owned businesses, a focus on corporate governance, a focus on environmental best practices, and often technology transfer and the implementation of best practices that have been developed in more developed markets coming to the region. So again, it's really a very natural topic for us, but one that I think, as we were talking even with the panelists before we got started, came together today, the language around ESG is somewhat new in the region. So something that we're going to be focusing on more and more going forward. It was about a year or two ago that we had within the scope of our Public Policy and Global Standards Council the decision to focus on ESG. Within that council, we work with EY and a number of other member firms to think about how we're going to address the issue. And the most recent project was one that we implemented this year. It was the first LAVCA EY deal book and ESG cases. This is the slide that I have behind me on the screen. It's a little bit difficult to read. There's a lot of small print there. But basically, we went out to our member firms and invited them to submit to us some of their cases that they were able to demonstrate not only a great financial return, job creation, value creation, but also some practices around environmental, social, and governance issues. So that publication is available for our website as a free download. We've been really impressed by the metrics that we've seen. It's actually had many hundreds, I think approaching like 1,000 downloads already, and we only launched it a couple of months ago. So again, it's clearly an issue that's resonating, and it's something that we will continue to be doing more in the future. So with that, I am going to hand the panel over to Mike Rogers, who's going to be moderating the discussion, and will introduce the rest of the panel. Michael is the global deputy private equity leader at EY, so he has the opportunity to look around the world and around Latin America and compare best practices and understand, what types of issues are concerning private equity firms. So he's in a great position to lead this panel. And with that, I'll hand it over to Mike.
Well, thank you, Cate. Thank you very much, and thank you to LAVCA for allowing us to play this role tonight and have this panel here today. So we're very excited about it. Just if I could introduce myself again, I'm Michael Rogers. I'm the Deputy Private Equity Leader for Ernst & Young on a global basis and operate out of New York here, and I'm very pleased to be here with you today. And if you take a second to set the stage, the topic of ESG that Cate has laid out here for us, you set in a backdrop where we've had significant improvement from the downturn of the private equity market that was just a few years ago really almost at a standstill. Global fundraising is up. Acquisition activity remains very robust. There's accommodative capital markets as well as great amounts of dry powder out there in the market to do transactions with. The exit activity is actually setting new records, and there's strong IPO markets around the world as we speak. And the corporate investors are starting to step off the sidelines a little bit, so that will impact what the private equity market does here, and the folks that are on the panel, and we'll hear from them later about that. So there's a lot of other issues that the firms are dealing with. They're diversifying themselves both geographically, they're moving around the world. They're also adding to their complementary products to their suite of products. So we're seeing much more diversification in the funds. But as they grow and actually gain in prominence on a global basis, there's also a sense that there's got to be more stewardship, more responsibility comes with that empowerment, if you will. And most of the funds, and you'll hear from them tonight, are developing best practices, developing robust infrastructures to make sure that they can accommodate the risks, the challenges, and the opportunities that are out there in front of them. Many of them are establishing ESG roles, and we'll hear tonight from the folks describing what it means in their organization to address ESG on a global basis and how they're formulating their business strategies around that. There's also an issue from the limited partners that are also beginning to put more and more pressure on entities around the world to act in an appropriate social fashion. But it's also a big issue to investors, stakeholders, and others around the world. It's becoming a mandatory component of building and maintaining a world-class private equity operation. But ESG practices, it's more than compliance. They can add value, and that's very quantifiable. We'll talk a little bit about that today as well. As this move, as Cate touched on, this move towards operational improvement continues to put pressure on the organizations to be well governed and incorporate these sustainable practices long term. It's really an opportunity for the acquirers to really focus on the strategic investors, potentially the public markets, and other private equity firms. So we've got that as a backdrop, speaking to the importance of this topic. And it reminds me of a quote I saw recently from one of the fund buyers. They said, "This is the first step is to bring about change in ESG is identifying and managing risks. The next step is to identify and seize financial opportunities for the benefit of the company, its stakeholders, and the communities in which it operates." And I think that's really what this panel is going to be all about. So I'd like to introduce my panel, and then we'll get started. Martin Diaz Plata, to my left here, is managing partner at the Capital Group Private Markets. It's a global private equity fund that does a lot of emerging markets investments. Carlos de la Fuente is based in Mexico, heads the ESG for the Ambrose Group. Most people would know them as a global growth private equity capital business. And to my right, Sebastian Villa is a partner with pan-regional firm Southern Cross, does a lot of Latin American private equity investment. And lastly, to my right here is Jarlath Gibson, who oversees business operations and risk at Advent International, which just closed, the largest fund ever in Latin America at over $2 billion. So congratulations to that, all right? So let's go ahead and get started. And I think how I'd like to maybe kick this off, and Martina, if you don't mind, I'll come to you first and just ask you, what does ESG mean at your organization? Because I think we're going to hear it means a little bit different, has a little bit different meaning at each organization. What does it mean at your organization, and maybe a little bit of background about your firm as well?
Okay. Well, Capital Group is an asset management firm. Our main offices are in Los Angeles. We were founded 85 years ago. We're better known in emerging markets as the creator of the first mutual fund ever dedicated to emerging markets growth fund. In fact, the emerging markets name comes from that fund. That was back in the 80s. And we founded Capital Group Private Markets in the early 90s. With a global approach to private equity in emerging markets. So we only have one fund at a time, and we invest on a global basis following a bottom-up approach. Our latest fund, which is the 6th generation, is a $3 billion fund that was raised a couple of years ago. I think before we start dipping into ESG, it's important to define yourself as an investor. Because that translates into ESG. And we are long-term oriented investors characterized by a very strong culture of ethics and private ownership. We invest in companies we believe that have a sustainable business model and good growth prospects. We value trust, transparency, and integrity and long-term relationships with companies. And we're very vocal in our relationship with companies. As listed investors, we will always vote on issues when we hold an equity stake on a company, and in private equity, regardless of our stake, we will always have a say in ESG matters. So what does it mean ESG for us, and what's our principles? First of all, ESG is the responsibility of every investment professional. It's not delegated to a separate person or a team, and it's not a question of whether the legal team or a junior investment professional. In fact, one of our senior managing partners is the ESG leader at Capital Group. And we take ESG breaches very seriously. It's, as we call it in the industry, a deal breaker. And in fact, we have passed on several opportunities of what we thought were good companies but had serious ESG matters. Second, ESG is integrated into the investment process, and we have the full pictures. Typically, good companies have good ESG practices. It's very rare to find companies that have a sustainable business model with having weak weaknesses on those practices. And if a company has been successful and we suspect that the ESG policies are not that great, we ask ourselves a couple of questions. One, how sustainable is that business? And a typical sustainability factor is labor policies. If it's built in weak labor practices, how sustainable is the margin derived from those weak labor practices? And second, what does ESG breaches tell us about the character of our partners, or characters if we're buying the entirety of the company, of the sellers of that business? And lastly, once you buy a company, an ESG breach is actually discovered, what do you do? Because you already made the decision to invest. And what you do is you take very swift, decisive, senior-driven decisions. And typically they're very hard and unpleasant because it requires the dismissal of senior managers. But you have to do that because you have to set an example for the organization. And in that regards, I will just finish when we were discussing an ESG matter with one of our co-investors, and he told me, well, the problem with you guys is that you always take a black and white approach on these matters. And I actually felt quite proud of our principles when I was told that sentence.
Okay, thank you very much. And Carlos, maybe you could give us a view.
Sure.
Of what does Abbraj think of ESG?
Sure.
on
Let me
a
just
global
give you a
basis?
brief introduction. My name is Carlos de la Fuente, and I'm the head of the Abbraj Performance Acceleration Group for Latin America. And just a brief overview of the group. We're a $7.5 billion firm, private equity firm with $7.5 billion of assets under management, with close to 150 partner companies in more than 25 offices across the region, and with 6 hubs in the world. And the one in Latin America is based in Mexico, and we have 13 investments in the region, 6 in Mexico, 3 in Colombia, 3 in Peru, and 1 in Costa Rica. And basically for us, I would say ESG is a very integrated it's part of our DNA, and it's basically embedded in every decision making process throughout the whole investment cycle. Since screening, the due diligence, when we do the legal documents, and throughout the investment, throughout the post-investment cycle, it's deeply embedded in every decision we make. And we look at it in two fronts. One is in terms of compliance and risk mitigation as a very important tool in that sense, but also in terms of value creation. We really see a great opportunity, and we're true believers of creating value through embedding ESG in our whole investment process.
Okay, thank you very much. And Jarlath, maybe I'll turn to you next, and just, you have a little bit of a different role within Advent than some of the other folks on the panel here, but maybe you give us a little bit of background on that, and what does it mean to your firm?
Sure. So I'm Jarlath Gibson, Advent International. We are a global private equity firm with offices in North America, Latin America, Western and Central Europe. As Mike mentioned, we've just announced a hard close to our most recent fund in Latin America. We have been investing in the region for 18 years. We've done 46 deals in the time that we've been there, so I think we're one of the older and longer companies in the region. And for us, I think, like you said, that for you it's embedded into culture, which it is for us, and we think about it too from our due diligence process, through our active ownership, how we drive value creation, through to how does it work for, where does it support our exits. But where I think my role is a little bit different than the other members on the panel is that I sit on our business operations team, and I work with our portfolio companies directly on their governance and risk management and ESG strategies. And that's something for us that we developed probably within the last 2 years or so. We started thinking, where can we help our portfolio companies? Where are the opportunities to help them grow? And so for us, that's kind of a big part of our G and our ESG strategy. And for us at Advent, when we talk about it, I think I've heard it described as it's a natural evolution of our business. It's about building talent. It's about growing businesses. It's about driving value. And so we talk about it as identifying risks and opportunities, but I think for us, it's really about improving business and engagement with our stakeholders.
Okay, great. And Sebastian, Southern Cross is uniquely focused on the pan-region market of Latin America, not necessarily a global firm. So help us understand what that means to you.
Yeah, a little bit different from the rest of my colleagues here. We are only Latin American investors. We only do Latin American companies. We are investing our fourth fund, which is a 1.7 billion fund, and we have done it for also over 15 years. We have offices in Mexico, Mexico City, in Sao Paulo, in Buenos Aires, in Santiago, and in Bogota. As I was speaking before the panel, and I mentioned to Cate, I was a bit surprised by the whole ESG concept. I have a slightly different perspective. I'm not sure how in Latin America you create value without ESG. That's why it was surprising to me that it became such an issue. In my experience, 90% of the companies where we invested, governance had to change dramatically, from virtually no governance because it was a family-owned company with a single owner deciding everything, to a company that needed actual governance standards and key metrics and professionalism and an audit committee, a compensation committee, independent board members, company that would be ready to go public or be ready to be sold to a strategic player, somebody who could not buy perhaps a family-owned company without governance. And the same goes for the yes. The grand majority of the companies where one invests in Latin America are companies that are associated with improving the social standing of the community. Housing companies, consumer companies, things that help society advance, and you get integrated with society. So almost all the investments that us and almost anybody that invests in Latin America does outside of commodity industries necessarily have to do with social advancement or social progress. So you have to improve the company standing in the society in order to succeed. So ESG, I think, I asked, does it have any translation? Per se, it does not have a translation into Spanish, and I suspect neither Portuguese. So it is a necessary condition to succeed for a long time in the region, to do this well and to do this profoundly. You also do it because you tend to live there. Our office in Bogota, it's staffed by Colombians. They want to do good in the society where they lived, where they were born, raised, their children live, et cetera, et cetera. But outside of the Good Samaritan perspective, which we all have because that's where we have decided to develop our careers, it's also because it's the only way to make money outside of commodities, at least, in our perspective.
Okay. So let's drill into the case studies that each one of these entities were kind enough to submit to our brochure that we put together that listed. It's a deal book. It has the ESG components to it. It's a pretty exciting document. If you haven't seen it, as Cate mentioned, it's on the websites, both at EY and at LAVCA. But let's drill in and look at the examples that you all brought to the table here and participated in this delivery of this piece. So, Jarlath, maybe I'll turn to you first. And you all did a deal called CTEP that was very successful for a number of reasons. But it was in the financial services businesses where you have some strength and some historic skill. So maybe you could walk through that example and how that played out.
Sure. So Cate is currently a public company. They are Brazil's largest private asset clearinghouse. That's where they are today. When we invested in them in 2009, they were an interesting story. They had 600 investors that were also their customers. So it was Brazil's largest banks, brokers, asset managers that were both the investors and the stakeholders. And so it created an interesting scenario of conflict of interest. And so Advent's first proposition was to go in and, as we often do, and restructure the board, but it was particularly important here to start to kind of mitigate some of that. So the first thing we did was start to change the board, put on some independent board members. Advent took some seats. The idea being that neither the banks nor Advent would have a majority ownership, and that we would kind of work through the process. We started to look at changing senior management. We were able to attract and retain talent with our network, with our experience. We brought in a new CEO, a new CFO, a new COO, all who were well known in the area, well known in the region, had deep relationships, deep product knowledge. They were able to really start to kind of help drive the business forward. We thought about, as all firms typically do, incentive compensation and how do we really professionalize this business and take it from something that was a non-for-profit, almost kind of back office support to these banks to a for-profit successful business that was able to list. And so with our experience, we were able to help transform that. In addition to changing the board composition, we started to form subcommittees, and we formed a pricing committee. And the thought behind the pricing committee was, for what had been a previously non-for-profit business, was that they would help drive what are the right products, what do they look like. It was recommendations to the board. It helped them focus their strategy, and that was pretty successful for them. The next part to it was we created some operating principles that were, again, used to figure out what are the right products, which line of business should they be pursuing. And through that, through the creation of the management teams, attracting real talent, focusing on product, we were able to take what was previously a non-for-profit company, build a pretty good infrastructure, and help list that company fairly quickly. It was a very successful deal for us, but I think it was also a very successful deal for the stakeholders. And I mean, to me, that's kind of probably a simplistic overview of how we did it. There was a lot of time and work that went into it, but I think it's an excellent example of, to your point, how do you do deals without changing, governance structures? I mean, to us, that was a classic, where do you start? And it was with the board, and that was kind of our governance example of, driving value through ESG. That was our value proposition.
Well, and I like the concept. You obviously changed the board. You made some governance changes there, but the actual stock compensation programs that you put in place for employees, that has to be something of interest to somebody that worked at a non-for-profit or maybe a family business where they're not typically used to sharing in the benefit maybe or the upside as much. Can you talk a little more about that in terms of how you set that up?
I may not be, as I said, I'm not, like these guys don't share the same background on the deal side, so I wasn't directly involved in structuring the compensation or how they do it. But I mean, it's very much a model that Advent thinks about. How do we attract and retain talent? I guess, it's part of, when we talk about ESG, that's a big part of the S, retention and development of capital, human capital and growth. So putting something in place that would allow, to align the interests of the business with the interests of those that we're trying to attract to help to grow that business.
Okay, great. Well, Martin, let me turn over to you here for a second. Now, you did a deal in the oil and gas space, which is maybe notorious for being one of the more dangerous spots, if you will, for ESG-related issues or FCPA, those types of issues. But tremendous job in terms of building the business, grew it dramatically, had great success, opening up some new platforms, drilling platforms, while you've had the ownership there. So maybe take us through that one, and what were the kind of steps, and what did you do from an ESG perspective there?
Good. Well, I wouldn't call it a dangerous sector, but certainly very sensitive, particularly in terms of the environment. We invested back in June 2010 in the leading offshore drilling company in Brazil. It's called QGOG Constellation. We basically own ultra deep water drilling rigs. They're very highly complex operations. Starting cost is $500 million, and is controlled, that company, by one of the largest privately held groups in Brazil, the Queiroz Galbao. Again, we invested in June 2010, hold a 25% stake, and have 2 board seats. So I will touch briefly on the ESG of QGOG, and more than recite what we've done there. On the environment, we obviously comply with all of the health and safety rules in Brazil, but in Latin America and in general in emerging markets, you actually have the opportunity as private equity investors to go beyond regulations. So QGG is an excellent example. We actually go beyond the regulatory framework of the sector in Brazil. And a couple of things are important in terms of the environment. One is very closely monitored by the CEO of the company, so the reporting guidelines are going to the CEO. And second, it impacts compensation. So we measure people compensation at the end of the year. One part of the compensation is environmental compliance. In terms of social, we try to have a few metrics on social. About 99% of all of our employees are local, 2,500 employees. We invested every year close to $10 million in training. And in terms of social, something that makes a lot of sense, but the best way to actually give back to the country in terms of social matters is provide fair and adequate compensation to the employees. And that's where private equity excels. Not only ties to compensation, but being fair in terms of every single angle of compensation. And in terms of governance, of course, as Sebastian was saying, this is the core of what we do, implemented corporate governance in terms of board and committees, etc. But something quite important that we've done in QGG and in other of our portfolio companies is the monitoring of that corporate governance. It's one thing to set up the corporate governance from the start, but how actually you track that corporate governance is working. A few examples. If you establish a whistleblower line to make sure that employees or third parties call an independent third party to report a breach of ESG matter, what happens if there is not enough use of that whistleblower line? Perhaps there's something wrong with the culture because people are not reporting those cases. What happens if an independent board member or an independent member of a committee leaves the board or the committee? We're not going to replace it with an insider or one of us, so we need to monitor that. And lastly, just because the auditor signs on your financial statements every year, it doesn't mean that everything's okay. So in terms of ESG matters, you need to establish your own set of rules to monitor that ESG matters are not being compromised, and not to outsource it just because you have the signature of a Big Four accounting firm at the end of each year.
So Martin, I know you had a health scorecard put in place as well to make sure that the employees were, taking security safety, into account. And you also have been assessed by the IFC in terms of the quality of the work there and making sure there weren't any mistakes or problems in your business. I mean, talk a little bit about that in terms of that monitoring you mentioned.
Sure, and there are actually very specific metrics in terms of health and safety. There's the IOC rules, and you need to comply with them. And the IOC performance standards is one of them. In another company that is actually in the same sector, which is actually an oil E&P company in Colombia, there are 146 requirements of the IFC performance standards. We now comply with 144. The two of them will be complied in the next 2 months. When we first started, we complied only on 101. So there are specific metrics that you need to follow in terms of health and safety, and you need to rapidly comply with those.
Okay, great. Sebastian, maybe I'll turn to you next. You had an entity called Cinemas.
Yeah.
And you were able to grow it very quickly. I like the fact that you were able to, add on other dimensions, other products to it, broaden the footprint of the business, open up a lot of new locations. Talk a little bit about that success you had.
Sure. MMC was a movie theater chain that focused in the interior of Mexico. So it competed in all the small cities and towns of Mexico, but not in the big cities. It was basically a local monopoly in 70 small cities in Mexico. What we did is expand to as many as we could as fast as possible and create over 100 local monopolies. So it was, let's say, conceptually, from an economic standpoint, a fantastic transaction. From an ESG perspective, it was also phenomenal. The E part, the environment, was excellent. We showed movies and sold popcorn. Zero impact. So we added no value. From a governance perspective, to your prior question regarding compensation and all these things, this is a family-owned company with a single owner for 40 years. It had no sharing of employees of anything, no stock option plan, no bonus, nothing. It didn't have any of the international auditors. It didn't have independent board members. We had a smaller fund back then, so we had to bring in investors, Morgan Stanley and a couple of very prominent families. So we had to set up truly U.S. public company standards in terms of governance and in terms of management. So from a governance perspective, a significant change, very significant change, which impacted performance. The biggest change was in terms of the social impact. The movie theater business is a very particular business. You have theaters that are full every night, or hopefully every night, at least on weekends, and are empty during the day, completely empty. You have a couple of employees cleaning, doing safety, all these things, but they basically remain empty. From a social perspective, it is very easy for the company to bring schools in to participate, what we used to call a day at the movies. So we used to bring the local public schools so they could have a day at the movies, each day a different. But it not only worked to promote the students and the kids coming to see what the backstage was, how a movie was shown, how it used to be 8 millimeters and not always digital, and have a class at the theater, but also for our employees. The manager of each of these 100 theaters was a local member of the community. His kids went to the school. So it was a very good from a social perspective, but also internally in terms of motivation, having our employees participate from society. So we benefited, I think, greatly from the fact that we did this program. We started out trying to do something social, and it ended up being a huge motivating factor, which everybody participated, and we had an idea, a box with ideas, where all the managers put in their ideas of how we could improve and all these things in the movie theaters.
That's fantastic. Let me ask you maybe a little tougher question. You did a lot of that with the community, and that really, obviously, I'm sure was very beneficial. There were a lot of underprivileged children, kids who would come to the movies, which I'm sure they appreciated. Did you see, same-store sales growth in those markets where you were reaching out to the community and trying to bring people in and do well in the community?
The easy answer would be yes. The truth is we don't know. There's so many factors that went into this. We did a number, 40 initiatives to improve attendance, improve the velocity, a number of things. It's very difficult. We never did let's say a correlation to the 28 initiatives, which one drove attendance. It improved, but I'm not sure if it was because of this.
All right. Well, for today's purposes, we'll say that yes, it was ESG, and it was excellent. It worked perfectly. Okay, Carlos, I'll come down to you, and we'll talk about Acurio, your restaurant network. And obviously, it's been a nice success. The ability of you folks to come in and grow the business, provide a growth platform, and also to build it out internationally, I think was really very strong.
Yes. So basically, we have an investment that it's called Acurio Restaurantes in Peru. I would say it's it was founded 20 years ago by Gaston Acurio, who's one of the leading chefs in the Peruvian gastronomy movement that we're seeing a boom right now internationally. And it's been able to grow significantly, rapidly within the last few years. Right now it stands at 42 restaurants, both within Peru and mostly in the rest of Latin America. And 13 of those have been opened in last year, basically. So there's been a very rapid growth. And right now we're helping them also grow internationally. They recently expanded. They have 3 restaurants in the US, for example, one La Mar in San Francisco, recently opened Tanta in Chicago, and another La Mar in Miami. And we're helping them further expand internationally. And we've identified a list of cities, and next year we're hoping to expand into Dubai, London, and possibly Washington. And I think it's a great example, Acurio Restaurantes, in terms of the ESG component. I would say from the corporate governance standpoint, we've helped them institute, when we invested, a formal board with independent board members with different expertise in the retail sector and the consumer goods sector as well. We helped put in a CFO who really institutionalized the reporting and the financial reporting of the business in terms of becoming international standards, and also implementing certain subcommittees within the board that helped us reinforce the corporate governance element. But one other element that I would like to emphasize, that I think it's a great example, Acurio, is in the environment and combining it with the social aspect. And I think they have a very clear example where they've been able to effectively engage the local community and create value, and also for the business itself. And they've not only done a waste management program where they've not only complied with the local regulations but gone further above and beyond what is required, but in terms of procurement, they've done an initiative where they've gotten very close to the local fishers and farmers of those communities to try to eliminate intermediaries, and also in terms of guaranteeing a reliable source of their key raw material, which is fish. So they basically partner with those local fishers, and they've helped them institutionalize, grow, earn a decent earning out of, and help them really become more professional in their day-to-day operations. And also in terms of making sure they respect the blackouts periods in terms of when they're not supposed to fish, and in terms of complying with and promoting the use of less popular fishes, and complying with the sizes that are required, and not only the sizes but also the types of fishes that are caught in certain regions. They're not only helping that local community, but also you are making sure that you have a reliable source of your main raw material, not only in the short term, but you're also protecting the environment, the biodiversity, and making sure you have a long-term sustainable business and supply of raw materials. So you're not only benefiting yourself as a business, making it sustainable in the long term, but also helping the local communities and promoting the local fish and developing that industry. So I think that's an interesting example where that particular company has been able to combine the environmental, social aspect together with a value creation and from I would say sourcing standpoint, which is critical for that business.
Okay, and maybe you could tell us a little bit about the culinary school, which I find fascinating that
Yes.
Your chef was interested in passing along his knowledge, his skills, and
Yes.
so you had this culinary school where you took some folks from underprivileged areas,
Yes.
put them through the school, and they've gone out now and become chefs on their own at different
Exactly.
restaurants, some of
Yes.
yours.
Yes, definitely. So that's another initiative where the idea was to give that opportunity to a lot of aspiring chefs, and it's a school where they attend formal classes, and then afterwards some of them graduate and go to have the practical experience within Gaston Acurio's restaurants and elsewhere. And it's really about promoting I would say the function, the chef. I would say the chef function, but also in terms of really privileging underprivileged societies of segments of the society, in giving them an opportunity. And one of the, I would say, the philosophy of Gaston Acurio and Acurio Restaurants is really to promote, not only provide a high quality good and service, but really promoting the culture and really making gastronomy a way to expand the Peruvian culture within Peru and elsewhere internationally.
Okay, great. I look forward to going to your Chicago restaurant and enjoying your fine cuisine.
Yes.
So Martin, let's move on to the next. Thank you very much, all of you, for going through your case studies there and sharing that personal examples. But Martin, let's go through and talk a little bit about why do you think ESG is moving up to the forefront now? Why is it becoming more popular and more of a requirement, would you say, in today's world?
Well, ESG, and some people in the panel already mentioned, has always been with us. ESG is a relatively new term, so a lot of what we hear is a branding exercise, is a repackaging of a few concepts, and then somebody came out with the acronym ESG that encompasses a lot of things: environment, social, government. So
Right.
you put everything in one basket. But it's a really useful acronym because it allows you to think about it in a more structural fashion. So part of it is a branded consequence of the term. Also, LPs are being more aware of it, and LPs are important for us because they're the ones who provide the funding, and therefore, if they demand it, then they will provide. But in terms of why we do it, if you think about why is driving ESG, regardless of the fact that LPs are demanding it, particularly sovereign wealth funds and state pension plans. One is because it's part of our value added as private equity investors. Companies look at us to provide those tools in terms of ESG, particularly as global investors. You tell us what is done in other markets, and then we try to get closer to that. So in that sense, we have almost an obligation to provide these tools and the framework. Second, is part of our exit strategy. If we want to take these privately held companies to the public markets or want to sell it, it is important that we have very solid foundations in terms of ESG. And this is where ESG gets exciting, because we are change investors. We are the one who provide these tools for change and to embellish these companies, not only from the financial performance point of view, but they are actually good companies and they're very well run. And lastly, and this is what private equity is all about, ESG is a driver of value creation. It enhances the brand, the reputations, the community with the relations, and this drives value. Our companies are valued, I don't know how much, and it's hard to measure, but ESG adds value, and we have seen it with companies that have very good reputation, where people feel to be associated with it. It drives talent to your organization because of the reputation that somehow companies hold by behaving well in terms of community matters.
And Jarlath, I may come to you on this because you have, I think, a unique perspective coming from a compliance background. And I think you even mentioned to me earlier that at one point this was sort of viewed as more compliance related, more sort of mandatory, and it's migrating towards more value add and being more addition to the company.
answers your question, why do we think that's happening?
Yes,
Or,
I mean,
yeah, I think that when we first heard this talked about 5-6 years ago, when it first started coming out of, I would say, maybe a little bit more to European LPs initially,
right.
it was kind of a thought of, okay, well, what are the things you have to do? Or we think about it in terms of government-specific things, FCPA, making sure that there are checks and governance checks. But I think what maybe the private equity industry as a whole has realized is this is value creation. This is what we do. Like Martine said, we've rebranded a lot of things we do, and we're now calling it ESG. And that's not just about compliance or just about risk management and identification and mitigation. It's about what private equity does well, which is recognizing opportunities to create value. And so many of these things that we kind of put in this ESG category are just that. They're opportunities for growth, they're opportunities for development, they're opportunities to enhance value. And I think that as an industry, I think people are seeing that. There's brand recognition. It's a way to differentiate your brand. And the companies that I think do it well, I think are seeing benefit from that.
Okay. Anybody else on that? All right. Well, Sebastian, I know you've been waiting. I want to come back to you for this question about what are some of the specific challenges around ESG? And we've highlighted a number of the good things. They sound good. It's very positive and optimistic. But what sort of challenges do you see out there relative maybe to environmental, regulatory, human resource issues, taxation, that sort of thing? What are your concerns as you think about this topic?
In general terms, I think the grand majority are opportunities. As I mentioned before, a big chunk of the value that we bring to the table is improving the social opportunities that are created within the companies that they bring to the community and the governance of these companies. And I think it will continue to be for a long time, so long as the primary source of companies that we acquire, all of us, are family-owned companies. I think this will continue to be the case. I do see a major challenge in terms of taxation. I think tax evasion is pretty widespread. It is complex to deal with. And when it is widespread, the rates tend to go higher, which leads to more tax evasion, and the taxpayer, like all of us, have to deal with that. You need to create sufficient scale and sufficient competitive advantages to win in the marketplace despite this. I think the biggest challenge, that across the board will exist, is taxation. I think the environment regulation is improving dramatically in some cases, like I think maybe in Colombia in oil and gas is overshooting compared to other places of the world, but it is getting to global best practices very quickly. Governance and social things, I think, is what we do well as an industry. And taxation, I think, is a challenge for the region, and I think governments will continue to fight it, and it will be a long battle that eventually will disappear. But that is the biggest challenge. As a challenge, framing it as a challenge, that's the biggest one. But the grand majority of the things, I think, are all opportunities, and things that we do well and we know how to do well.
Okay. Carlos?
Sure. I would say in terms of the medium size companies that we invest is really making, I would say the challenge is convincing our sponsors that ESG is a fundamental part of the way we do businesses, and that it has to become, that there needs to be a very strong commitment towards that. So I think there's an education aspect that sometimes, because sometimes it requires some levels of investment. So making that change and convincing them and really influencing them to see that value in committing to ESG, I would say that's one of the challenges. And I would say also in some of the markets where we invest, I would say dealing with corruption, I would say that's also a challenge, and the way we approach that is very strict, because we're representing the interest not only of our core values, but also in terms of the LPs that invested in us, that we're doing taking due care and really doing a very thorough analysis of the practices that are being done in the companies that we invest. So there's been some instances where because of that particular reason, we have taken decisions not to invest in some businesses that might might appear to be, from only the economic pure standpoint, very attractive, but if they're not willing to commit and really to adhere to our values, that's something that we're definitely not willing to do business with.
Okay. And Carlos, let me come back to you, because Ambrose is truly global. You're in emerging markets all over the world. You're
Yes.
doing deals in all sectors. So you're a great litmus test for this question. Do you have a standardized playbook or something that you, routine anytime you go into, you
Sure.
mentioned the
Yeah.
diligence side of things, but as you get in there,
Yes.
how do you start to implement some of these ESG concepts
Sure.
in each organization you buy?
So we try to approach it in a more structured way. So basically, it's as I told before, it's part of our complete deal cycle since the beginning, since we do a screening of a company, and when we get more deeper into the due diligence phase, we have developed internal tools to measure the level of risk at two levels. One would be inherent risk, that we call is the industry-related risk, and we measure the risk in terms of the health, safety, environment, and social component, and we assign a particular score in that sense. And then the residual risk in terms of, depending on that risk factor, what is the company-specific risk and how sophisticated and evolved their management systems need to be able to address those risks accordingly. And we also assign a specific level of risk, and depending on that, we come in with whether we have internal resources to help us for that due diligence, or if there's a really high risk in particular areas, we might require an external ESG expert in that particular industry to come in and help us do that assessment. And in that overall assessment, we identify what are the key gaps or opportunity areas that the company needs to close the gap, and we help them develop a very specific plan with KPIs that we monitor throughout the investment, throughout the life of our investment, in terms of supporting them to comply and to achieve that plan, which we call corrective action plans, which are specific initiatives with very clear deadlines and people responsible for achieving those initiatives throughout the life of the investment, both in the compliance or risk mitigation side, and also some in the more value creation aspect of ESG.
Okay, sounds like some best practices there that other firms may want to try and replicate over time. That's a pretty robust process there. Martin, just touching back to from a sector or an industry perspective, I made the comment that about oil and gas, and that might be one of the most scrutinized of the sectors. Are there any sectors that you would shy away from, or you have concerns about relative to ESG, or maybe corruption or other issues, their taxation, or is it hard to make a blanket statement around that?
It is hard to make a blank statement. Of course, if companies have serious breaches of ESG matters, and you discover pretty early in the due diligence, then, as we call it in the industry, is a deal breaker for us. But you have to understand that in each sector, ESG means something different, particularly the implementation. For example, in a financial services company, we own the largest non-bank financial services company in Chile, and our ESG efforts are very focused on compliance of money laundering rules. And that's, that you don't see that in natural resources. It's actually not an issue in natural resources, but in financial services companies is. We own, just to quote an example from a company outside Latin America, we own the leading media company in the Philippines. And as a media provider, and I know there are some members of the media here, you have a social responsibility to act in moments of crisis. And in this particular company, where Typhoon Yolanda hit the Philippines last year, that company was at the forefront of fundraising efforts with actresses, the senior management of the company, to try to raise funds, to try to raise awareness of that disaster that hit that particular country. So in each sector, ESG materializes in different ways. So yes, we have a standard set of guidelines, but in terms of the implementation, it means something quite different.
Okay. And Jarlath, if I might turn back to you again. Just chat, we heard a little bit about process and procedure from Carlos, but maybe backing up a step on the due diligence side, given the risks that we've talked about here a little bit, what's that process like for you folks at Advent in terms of due diligence prior to deals?
So we have a pretty rigorous due diligence process. We always have. We look at, depending on the sector, the geography, we tailor our diligence. There are certain things that will always be standard. There are certain core principles that will always apply. Anti-corruption, for example. And then, we tailor that then based on, is it something that, is a sector where we need to be more environmentally focused. You were joking earlier about the movie theater and no environmental issues there, so some have more, some have less. But I think our goal is to be, standard and uniform, but also targeted on, specific risks and identifying those risks and understanding them. And we do the same thing. We use a combination of in-house resources and external consultants and experts to help us kind of really dig down and assess what our risks are there.
Okay. Great. Well, I'm conscious of our time, and I thought maybe I'd give each of you just one last minute or so to kind of lay out any thoughts that you would like the audience to take away. So Sebastian, maybe I'll start with you, and just if you had to boil it down and leave folks with one takeaway, what would that be?
I think one of the reasons private equity exists in Latin America is because of ESG. The grand majority of companies, as I mentioned a couple times, are family-owned companies. The reason they approach private equity, they tend not to sell 100%. Very few of us have acquired regularly 100% companies. Is because they want what is called in the street level language, take it to the next level. That means governance, improve management, improve social perception, all the things that we do as an industry. It's the biggest source of deals that we have is to be very good at ESG. So I think it's a topic, that's why it sounded a little bit foreign to me for Latin America. It's part of what we are. It's like speaking about our skeleton. This is what makes a big part of the industry in Latin America on an everyday basis for the last 20 years. It's not something new. It's packaged differently, but it will continue to be the biggest deal source in my mind in Latin America.
Okay, great. Charlie?
So building on that, I would say not only is it something that's not new, but I would also say that it, like you said earlier, it's more than compliance. And I guess that's what, coming from a former compliance person, it's a little ironic, but I would say that this is something that really is more than compliance. It really is about opportunity and value creation, not just risk mitigation, but really value creation. And I'm excited to kind of be here doing this and watching this develop and watching our industry start to think about, what have we done historically really well and how can we continue to drive that forward?
Okay, Martin, last thought.
Well, what is the hardest thing to do when we invest in a company to change? Culture. If you manage to get into the culture of a company, understand how it works, and if somehow that culture is not conducive to act as a good citizen, you need to change the culture, and that's the hardest thing to change. But as private equity investors, we are very well equipped to change our culture, and that means how people are compensated, how people are managed, how people treat each other, and how people react to certain community events, etc. So for us, being agents of culture, that's one opportunity and exciting for us, and is the reason of existence of private equity, really.
Okay, Carlos, last thought.
And to us, I think it's very important in terms of looking at ESG, not only from the compliance and risk mitigation front, but also in terms of really the opportunity to add value to the core of those businesses. And one thing where we've advanced is in terms of trying to measure the impact of those initiatives. And we have come up with an index that's called the Ambrose Sustainability Index that measures certain variables, both quantitative and qualitative, around different categories. And that has helped us, I think, monitor our companies amongst themselves and across time how much they're progressing. So I think being able to find a way to measure, because it's not always easy to measure the advances in sustainability. I think there's a great opportunity for businesses to start measuring in a more structured way.
Okay, thank you. Well, I know we have a couple minutes before the reception. So I'd like to open it up to the floor for any questions, if anybody has any. Yes.
Hi, Sergio Diaz from Kirkland & Ellis. There was mention about the benefits of ESG, but not necessarily the reference to the cost of ESG. Has there been any analysis as to how the cost of compliance has affected your IRR, or have you passed on opportunities because of the cost of compliance?
Okay. Anybody? Sebastian?
We have passed on many opportunities because of compliance. I don't know about the cost specifically measured as such as an economic number. But one of the investments we own, for example, is a housing company in Mexico. It's the largest home building company for the low income sector. Huge social impact. People who didn't have a proper home moving for the first time to a proper home. And we own that company. We have owned it for 4 years. And our homes used to cost nearly $500 more than the rest. $500 out of a $20,000 home is a huge amount of money we left on the table for many years. Our homes had a higher upfront cost, but a lower cost of ownership. It had solar panels for heating the water. It had better insulation. It had a better layout. For example, the homes didn't face the sun in the afternoon, so you didn't have too much heat in the homes. Little things like this made our homes a little bit more expensive. And during the first few years, it did impact our IRR. But today, we have double the IRR of anybody else and double the size of anybody else. I think it was more a long-term thing, and the customer has come to appreciate the difference in the cost of ownership. Similar to the US, which is a more sophisticated market in terms of cars, how they measure cost of ownership of a Toyota Corolla versus, I don't know, a Cadillac, whatever. The dollars per mile. This is the same concept. The customer has come to appreciate how much cheaper it is to own a better home despite the slightly larger upfront investment.
In terms of cost, we think that the costs are minimal compared to the benefits because, and the main cost is really management attention. It's not monetary cost, is management being focused on that. But imagine how much will it cost to remediate situations that emerge from breaches of ESG. So for us, it makes perfect sense, not only from a moral or value point of view, but for a valuation point of view.
Well, I think if you would turn your attention to the Ernst & Young Latin American Value Creation Exit Study, it's on our website. There is a lot of discussion about the attribution of value that is created through the exit process. Much of what was discussed here in terms of leadership, in fact, the deals that we looked at, almost 80% of them changed the chief financial officer out. So that changing the management team, putting new folks in there, improving the financial back room, the systems, reporting, those all have costs. But that also meant an accrued benefit on the exit in terms of the performance of that entity. So there is some statistical work around that, and I just refer folks to that study if they're interested in more of that. Anything else? Yes, sir.
Hi, my name is Adrian Dixon from Blue Heron Research Partners. So Martin, you were just saying that the biggest challenge that you have is effecting change in a company. So my question is, how do you go about doing the qualitative due diligence of a family company and establishing that baseline, understanding what the culture of a company is, particularly if it's been in a family for 1 or 2 generations, and then effecting that change?
Well, culture materializes through many aspects of a company's management. Is the compensation, is the delegation of authority, of how actually they deal with problems in the past. And there is no substitute for extensive due diligence, spending time with your potential partners, because at the end of the day, it's about getting to know them. In Latin America, it's actually a bit easier than most emerging markets because most of the companies in Latin America tend to be relatively old, as opposed to China or Russia, where there is a lot of new enterprises where you find people in their 30s that are quite wealthy and they don't have a background. In Latin America, that's not the case. So to answer your question, there is really no substitute for spending lots of time with the partners. Obviously, you need to perform your typical due diligence procedures from an accounting, from a legal, from a reputational point of view. But getting to know your partners and performing extensive due diligence is the perfect antidote to avoid troubles in the future. And then about changing the culture is really about not only getting to know the CEO and the CFO, it's about getting to know the organization itself. And again, there is no substitute for extensive due diligence on that point of view.
Can I add something to that? I think it helps a lot to have control and to be very deeply involved with the company. If those two things are not there, it becomes more difficult.
Just to add on that, for example, we have a very detailed set of checklists and guidelines that help us in different aspects within ESG to make sure they comply with all the laws and regulations, and they have policies in place, they have training, and they have all the mechanisms in place to monitor that. But I think one fundamental aspect is, like Martin said, really understanding the mindset of the sponsors, whether they have the real commitment to making those changes or not. And I think that's one of the, and that is not substituted by really kicking the tires and really spending the time, really getting to know the management, their culture, and what their values are.
In general, they have already made the first step, is trying to find a private equity partner. The fact that they have already done that is a sign that they actually like to change. So that's a first good indication.
Okay. Any other questions? Okay. Well, here's one more here.
Hi, I'm James Bosworth. I'm Director of Analysis at Southern Pulse. One of the questions you're helping companies ESG, but obviously the companies are competing in an environment with other companies that may not have the same level of respect for ESG. If you're dealing with a company and you put a bunch of anti-corruption compliance in place and they're competing against a corrupt company, they're not going to win. Or they're not going to win in the short term at least. Same goes for environmental regulation. What sort of push do you put, how do you push companies to try to better their countries or their governments overall? Do you see that as part of ESG? Is it just about doing the internal company, or is it about telling the governments, having the companies pressure the governments to do a better job on taxation or environmental regulations or anti-corruption efforts?
I can talk about what we do. We tend to shy away from companies that are deeply involved with the government. So highly regulated industries, companies with a lot of exposure to legislators. I'm trying to think of some, but very few we have participated in. It tends to be in the more serious countries like Chile or things like this. In countries with less interaction with the government, I think the increase in productivity, the improvement in the social culture of the company has a tremendous impact in the local community or in the country. So I think we create a substantial amount of benefit in those companies. It is true that we do not, at least in our case, we don't know how to navigate the governmental spheres, and we haven't and won't, because it's not our talent. And the LPs also ask us not to, but even if they did, I wouldn't know how.
Maybe to follow along on that question a little bit, because I think maybe where he was going with it is, have you ever, been involved with business councils or different things to try and improve the economies or the business practices in those markets? I mean, is that something that's ever come up?
Well, let me give you an example. In Vetra, the oil E&P company we own in Colombia, just to answer the question of how to deal with governments, when they centralize tax collection of oil royalties in Colombia, that is something that macroeconomically makes a lot of sense. They centralize them all, and they ask municipalities, present us projects, And if they're good projects, we'll approve them. But the question is that the people in the Putumayo region, where our main operations are not capable of putting together these projects. So the people who are benefiting from that are the people from Medellin, from Bucaramanga, from Bogota, who have technical teams that actually put together these projects to present to the DMP in Colombia. So what are we doing in Putumayo? Sitting down with the majors and say, you want to build a sewer system? Well, let's actually create that project and let's send it to DMP. So that's an example of actually proactive involvement of our companies in terms of dealing with the governments. No?
That's good. Okay. Sir.
Hi, I'm Ruben Ferrer from Gómez de Compombo. You invest in different countries with obviously different levels of regulations. So my question was, where do you set the standard considering the different legislations, particularly when it comes to environment? So you try to have like a set of rules that are applicable across the board. Do you somehow have different nuances depending on the country? Like for instance, you were discussing about anti-money laundering. So I mean, it's very different, obviously, legislation. So, and is the same, I mean, mirroring the US towards Latin America, Europe towards Latin America? So how do you set the standard and whether this varies depending on countries or type of investment?
So let me take that one. We at Ambrose have an internal set of standards that are, we would consider them to set at a very high standard. And there's obviously differences in terms of the legislations in the different countries where we invest. And what we try to do is never go below our own standard. And if in that particular country the local legislation is below that standard, we'll go up to our standard. And if it's above our own standard, then we'll go and comply, make sure we comply with all the local rules and regulations. But what we tend to do is have internally a very high standard to adhere with, and minimum, that's going to be the minimum standard that we try to adhere in every single market.
And for us as a global private equity firm and also a US-based firm, not only do we seek usually the highest level of standard, but we are also you gave the example of anti-corruption. For us, we are always looking to comply with FCPA for regulatory reasons and because we just think it's good to be consistent in our standards. There's a reason they're there. We think anti-corruption is very important regardless of the country, the region you're in. So we always seek to have the highest standards.
Okay. Any last question? Yes, ma'am. Okay. Sebastian, you want to, you're coming from Mexico standpoint, so.
I think we invest in other countries for almost 20 years. I don't see such a huge difference, actually. There are times when some countries kind of fall off the map a little bit and start complying less, like Argentina has been for the past few years. But it will come back, I'm pretty confident. So over time, I think the whole region has progressed, and I see pretty standardized, high-level, increasing levels. Environmental, I think, has been tremendous. The improvement of the regulations and the observance of regulations throughout the region. I don't see a significant difference. I think all countries are very, very active. And in terms of social and governance, like Martin mentioned, and we said a number of times, look, this is what the companies want, and they need this to improve and to get to a new stage in their corporate life. So, and that's across the region, even outside Latin America. It just happens to be that Latin America really needs it. But
any thought?
Well, imagine we're a global emerging market fund. So in addition to dealing with the difference between Mexico and Colombia and Brazil, we had to deal with We currently have investments in Russia, in China, in India, in the Philippines, in Nigeria, which is a very interesting country in terms of ESG matters. And what we try to do is to assess what's the level of impact we have as an investors. For example, I was just reading before this panel a statistic in our company in Nigeria. We actually operate in the oil and gas sector in Nigeria. We're the first company that ever built a gas pipeline in Nigeria. And we have a record of 9 million working hours without an accident in Nigeria. Which, we're very proud of it, because no company operating in the oil sector in Nigeria has complied with that level of record. And a different aspect of that materializes in China. I was just talking to somebody recently about China, how state-owned companies are actually looking for private equity in order for them to have an external force of change. Because it's very hard to change yourself as a state-owned company. So they are actually looking for private equity to implement that change, but sometimes it's consolidation, sometimes it's corporate governance, etc. So it materializes in different ways, but in general, I would also paint a positive picture. There is a general sense of progress across almost every emerging market in terms of ESG.
Okay, maybe last question, maybe.
Alex Merchant, JP Morgan. One quick question, as you think of taking some of these companies to the public market, and you're working with partners, who are looking at public equity. Can you talk a little bit more about sort of the development of local institutional investors and sort of the demands that they're making of companies? I know in Mexico, with the development of the FIBRA sector, the Afores have, pushed back pretty significantly about fee structures, about independence of board, and how is the development there, and those players sort of expanding outside of fixed income in a lot of these countries, being a push on the exit side, and how do you sort of partner with those anchoring institutions on the way out? Thank you.
Mexico in particular, which you mentioned, for example, in terms of the fee structure, I think the impact is dramatic, the request. Let me take the REITs versus C Corps in the real estate spectrum. REITs trade at a cap rate around 7 to 8%, but they have a whole system of fees outside what the investor sees, which the controlling family takes home, and the public investor doesn't take. In other words, it's a minority unprotection, and they have a cap rate of 7 to 8%. C Corps, which are fully aligned in terms of fees, and they have, in other words, complete minority protection, their cap rates are 5 to 6%. So there's a 30% difference in value if you behave well or misbehave. I think that will drive behavior. In the past, that alternative didn't exist. It was very, very difficult to be a minority investor in public markets in Latin America. You counted on having a very trustworthy family. I think the Afores and the AFPs and all the pension funds are putting a lot of pressure. They will put increasing pressure, and because they exist, they are creating this association, or this, let's say, association between price and good behavior. And in the real estate market in Mexico, I think is a very, very clear example of how they're significantly differentiating between a well-behaved player and a misbehaved player.
Anything else to add? Okay. Well, I think that we could go on for quite a while here, but in the interest of time, we will have to leave it there. I think, first of all, I'd like to thank the panelists, Sebastian, Jarlath, and my friends Martin and Carlos on this end. Thank you both, all of you, very much, and we appreciate LAVCA's support here, and Cate. And I think hopefully everybody takes away from tonight that doing the ESG is not just about doing good, but it's good for business. And I think we heard a lot about that this evening. So thank you all for attending.